Well, welcome to another episode of Breakaway from the Rat Race. And today I have the pleasure of speaking with Kent Ritter. And Kent has been investing right now since 2019 in a syndication business where he acquired over 600 rental units valued at over $50 million. Prior to that, Kent was leading the private select business unit out of Birge Held Asset Management. And that's where it's kind of his real estate MBA, as he calls it, where he learned how to really manage like $1.5 billion in assets and totaling about 15,000 units. And prior to that, Kent was a partner in a management consulting firm. And so he played a central role in growing the business up to 95 employees. And he sold that business after that, and we're going to talk about that, how after he sold his business, kind of how he used this asset to get kick-started in real estate. Kent, on top of that, is the host of a very successful podcast called Ritter on Real Estate, so you may want to follow that as well. Kent, welcome to the show.
Thanks, Eric. Appreciate having me on.
Oh, my pleasure. So that's great. So great story, management consulting. So you learned quite a bit about, all the, so I did some of that as well. And you kind of learn a lot about all the different businesses. And so I really, if you love business, doing management consulting is fantastic for that, because you do these projects and then, and then you learn the business, pharmaceutical business, and then you go in biotech, and then you go into all kinds of things. But tell me more about your experience and what you got out of that management experience.
Yeah, I mean, what you described is exactly why I became a management consultant in the first place, is because I knew from being a small child that I wanted to own my own business, and I later learned that was called being an entrepreneur. But I didn't know what kind of business I wanted. I just knew I wanted to have my own, right? And so, as I was going through college, I mean, I kept that same mindset. I still didn't really know what I wanted to do, but I went to business school because, again, I wanted to learn about business, and I knew one day this would all come together into something. And as I was looking at what I wanted to do next, I did an internship as an accountant between my junior and senior year, and that was enough to tell me I did not want to be an accountant. So,
okay,
so I.
But it didn't kill your business entrepreneurship spirit. Okay.
No, it just killed my accounting double major. I ended like 9 credit hours short because I went back my senior year and it was like no more accounting. So, but I still got the finance degree in the econ. So, but anyway, I had an opportunity to join a management consulting firm. And I thought that was a great opportunity because coming out of school, because again, I would get to see a lot of different businesses, understand how businesses work, get to solve problems. I knew I didn't want to be stuck in a cubicle. Like I knew that wasn't me from the accounting internship. So I get to travel all around, do all that stuff. Right. And so I did that for 12 years. I traveled around the country, helping different businesses solve big problems essentially. And yeah, like you said, you learn what makes businesses successful, what makes them unsuccessful, more of like the what not to do than the what to do, because they don't call you when it's going well. But you really get to learn like the levers that make businesses work and like what really matters. And, I look at real estate at the scale that I do it, buying these large apartment buildings, as buying businesses. I mean, we're not buying a house, we're buying a business. It's got revenue and expenses, and it's been cash flowing typically for 30 or 40 years. And so it's really, how do you optimize that business? Just like any other business, how do you decrease expenses? How do you increase revenue? How do you do better marketing? Right. And so I really take a lot of the principles from that management consulting experience and my experience of starting, being there like from the beginning of a startup and taking that through exit, and take that all into my real estate investing. I think it all applies very well.
Mm-hmm. Yeah. So that's very good. I really enjoyed it. I think it's, I'm glad I'm not doing that anymore, because
I mean, it's a grind.
It's really a grind. And then you're never home. You're always traveling, and then your kids don't recognize you. And I know you have like 3 kids under 5. So
exactly.
That must have been a very challenging.
Well, and that was one of my big catalysts. So when we sold our company, in 2015, then we all went to work for the company that we sold to. When you sell a business, they don't just let you walk away. We had earn-outs that we had to complete. So I was a management consultant for 4 years after we sold that company, working now as an executive for the company that we sold to. And during that time, I had my first daughter and my second daughter. And that was one of the huge reasons of why I knew I wanted to get out of management consulting, because, you're gone all the time. And I started looking at the guys that were like 10 years ahead of me and started asking them, like, how do you manage this with family? How do you do that? And I just didn't like the answers I heard. A lot of it was, well, I've been married 3 times and I've been divorced, and, they're like, oh, my kids don't really want me around anyway, so it's okay to travel. And a lot of those people, frankly, looked at the work week as like their weekend, and it was like, go out to the bars, do all this stuff. And it was just not what I wanted. I wanted to be home with my new family. And so I knew that I needed a way to exit management consulting. And, and that's really when I went from, because in 2015 and 16, after we sold the company, I started investing passively with other people in real estate, because I still had my full-time job. And I just at that point, I was only looking for really diversification out of the stock market, because I didn't want to have all my eggs in one basket. But as I continued to learn and really fell in love with the process, around kind of probably 2018, and then in 19 was when I started saying, okay, well, what am I going to do next as my earnouts coming to an end? Really had fallen in love with real estate and really started looking at this as saying, man, I think this is my next adventure. I think this is something that my skills would very easily apply to. And they have, and we've been able to, have a great run, and I'm able to see my kids every day. And I'm having more fun than I ever did in the management consulting business doing what we're doing. And so I just feel blessed right now.
Yeah. So the other thing too about the management consulting that I didn't like is that, I could literally see my hours and money. You work an hour, you get money. You don't work, you don't get money. So I was independent, and I was just like, oh, that was horrible. I would go on vacation. I'd be like miserable, because I say, wow, look, this vacation is costing me a fortune. Not only the cost,
vacation costs double. Yeah, exactly. Well, and that's a huge point. It's like real estate is one of the most straightforward vehicles to create passive income and quit trading your time for money, right? Like, it's awesome when I go on vacation and I know that rent is still coming in, and that's a great feeling, because I get it, like being the management consultant, and you charge hourly, and that's So after that, so you started investing after your exit from the management consulting company, and then you started investing in real estate. You really fell in love with that, and then you end up in which is a little bit. You went into that Birge Held, I don't know if I'm pronouncing it right, asset management. And so why did you go in there instead of just continuing to invest on your own? And then, I'm sure you had the skills at that time to venture on your own. So why did you decide to go to Birge Held? Yeah. So Birge Held is owned by somebody who's been a long-term mentor of mine. And, as I started getting in real estate, I actually started investing with them first off. And that was how I developed a relationship with one of their principals. And, and through that process, I was able to just build a lot of relationships within their organization. And I thought it was a really high class organization. I thought they did a lot. They've obviously been extremely successful. And I really, I had done one syndication on my own at that point, and my mentor was like, wow, I think honestly, he was kind of like, man, he actually did it. Like, look at this. And so he offered for me to come and really join as a partner on their platform, but start my own business unit and really focus on a niche strategy. And the thesis for him, the value prop was like, he's like, we are focusing on this giant mothership, 15,000 units, but I know there's opportunity over here. So if you want to come and use our platform to build out a team and focus on that, like I'll support you in that. And we created a separate LLC, a separate partnership, and kind of went out.
I see.
Went out and did that, and but I was able to.
That was that private select business unit. So that was an entity within the bigger entity.
Exactly. It was kind of like a startup within like a big corporation.
Yeah.
And so I was hiring my own team, and but I was able to leverage a lot of their back office, their accounting and HR and different things, and pay kind of a corporate allocation to do that. But so you asked the reason I did that and didn't keep going on my own. So I had to make a decision on like, do I want to be, a big fish in a small pond or a smaller fish in a really big pond, right?
Yeah.
And I look at this as a 30-year career for me. I mean, I actually just turned 37 yesterday, and I think this is something I could do for thank you. But I think this is something I could do the rest of my life. So I looked at it saying, you know what? At the very least, if it doesn't work out, I'm going to come out of this learning a ton with a much better network and a great pedigree, right? Of being at a top private equity firm. So that's how I looked at it. And it was a great experience. I led 4 acquisitions with them, raised all the equity, sourced the debt, really did it from beginning to end. We did 4 deals together in 2020. And it was a great learning experience. And so I came out of it, more confident than ever that as I went back, decided it was the right path for me to be back out on my own, the entrepreneur I am, wanting to have my own business. I just felt so much more secure in the knowledge that I'd had and the track record in doing that. And so that was why I did it. And now, since June of this year, I've been back out on my own, and we've closed on 181 units in 3 different transactions, and we're just rocking and rolling from there.
Wow, that's great. So so it sounds like that private select, that was a great kind of like, I would say like a safe environment where you can kind of like experience and say, okay, yeah, this is what I'm doing, and my business, and I can really do this on my own, and this is great. It's a safe environment. You learn everything. You have access to all these resources.
And the cool thing was because of their scale, we were able to do some really cool things with different vendors. So I started a technology committee when I was there, because I've always been very tech forward, and all the consulting that we did was very tech forward. And so I was able to really bring that kind of tech mindset, I think, into the company. And we started a technology committee, and we were able to do some cool stuff like implement smart locks and self-guided tours, which are now being implemented across the portfolio, but started with the little group that I had, and even centralizing some leasing, like lead generation from leasing, and doing that in a centralized call center model versus relying on the property managers to do that. And it's had a substantial impact on that firm's portfolio. And so I'm proud of those things I was able to do. I wouldn't have been able to do that starting on my own. You got to have a decent scale, but now I know what I want to grow into as I grow my business.
Yeah. The other thing too that you mentioned, and I think people would kind of like, I would kind of like pass it over, but I think this is very important. You mentioned something about not being the small fish in a big pond, and try to find the pond of the right size, basically, for your business. And I can't emphasize that enough, because I think what I'm seeing too, and it was the same for me when I started investing in the San Francisco Bay Area. I was trying to get into these deals, and then I would always, like, the numbers never made sense to me, because I had to get like hard money lending. I had to get like subcontractors that I had to pay, contractors that didn't work for me. I had to go and get them, and everybody was, I had to pay the realtors and all of that kind of stuff. And the numbers really at the end didn't make sense. I was making like 2% return, and I was putting like lots of money at risk for that over a number of years to get that done. And that's because I was the small fish. I didn't have enough money really to play in that pond. And everybody was just like, oh yeah, that's only $2 million. They would put $2 million down. Or for me, like, it's like, oh, I need to get some money for that. Yeah. But really finding, and then that's when one of the reasons why I moved to, not moved, but I started investing out of state, started investing in Memphis, Cleveland, St. Louis, where my money was going a lot further. And I was able to kind of like work with contractors and all of that. And I think that's important, because you find the right place to invest, that where it's the right size, the market it fits your economics. And so I think I just wanted to mention that's something that's very, if you find yourself that you're always hitting your head against the wall, against something that's bigger than you and all of that, consider kind of like looking at a different market to make sure that your money works for you.
Yeah, and I think that even just maybe a different size of assets. So
Yeah,
a lot of the groups, a lot of folks that come out of like groups today, I hear we got to buy 100 plus units, got to buy 100 plus
exactly.
units.
Yeah,
We've had a ton of success buying 50 units, 48, 29, 30, 75, like all kinds of different unit sizes, because in that market, to your point, in that size of asset, there's less competition.
yes,
You don't have as many groups that are going to come in and put 2 million hard day one down,
yeah,
which you do on larger properties. And
yeah,
so if you don't have, especially in the market now, I mean, that's kind of the play, is throw down a bunch of hard money so that you can get a deal in a very competitive market. So going and doing some of those smaller deals at first to build a base, I think is a really good strategy, and can help people get into the game rather than like beating your head against the wall, trying to get, 150, 200 units and competing against, well, like the Birge Helds of the world that
yeah.
have, 20,000 units at this point.
Yeah, I totally agree with that strategy. And this is when we look at I do a lot of single family rentals, obviously with Martel Turnkey, but I also do a lot of like some apartment buildings. And then our sweet spot is below 60 units, uh, hopefully owner operator. So they do self-manage the
Mhm.
property and stuff like that. And they're at the point now where they held the property for 20 years and they're tired of that. They're tired of
Yep.
having to lease yet again another
Yep.
apartment and fixing problems and roofs and stuff like that.
Yeah. We
So
just bought two of those deals over
mm,
the past month,
yeah,
two owner operator, long-term owners, a 48 unit and a 29 unit. And
yeah,
yeah, they're both going to be home runs because there's just so many operational inefficiencies.
yeah, exactly. And this is, to me, that's the sweet spot. I know, and everybody that I talk to, 100 plus, 100 plus, 100 plus, and then just like, really, like this is. But again, I'm in the single family rentals in Memphis and Cleveland, and then nobody wants to touch the what I'm doing. So I have that niche, and
Yeah.
then nobody wants to be in there.
Yeah.
And it's highly transactional. I mean, we do 120 single family rentals a year. Nobody wants to do that because it's like, no, you don't make enough money and all of that. But yeah. So that's very good. So you started back to you, Kent. So Hudson Investing. So now you leave that private select business, and then that must be hard. That's a hard thing because you're leaving a place of comfort with Birge Held, and now you're venturing on your own. So tell me, talk about that transition over to your own company.
Yeah. I mean, it is a hard decision. It's hard to leave a place of comfort and get out of your comfort zone. And, but for me, it continuously came back to kind of this, I guess, desire I've always had to have my own business and run my own business. And I know that I'm good at building teams and I'm good at building culture because I've done it before. I've done it for my own company. I've done it for other organizations. And I knew that I wanted to ultimately build the company like with my own culture and kind of my own image and build my own team and really be able to just kind of control is the wrong word, but be able to
Yeah,
build the team
yeah.
as I wish with the culture that I wish.
Lead.
And yeah, and that was ultimately what it was all about. It was, okay, am I going to build this kind of under their umbrella, or am I going to take the additional risk and really do what I want to do on my own? And luckily I put myself in a financial position to have, some nest egg put away to be able to float, for a while. So I basically had, we had sold some real estate and we had, done a few things to position us so that we had a couple of years of, expenses socked away in a savings account that I could put toward that and put money towards starting the business, so we were able to be well capitalized from the beginning.
Mm-hmm.
And so I felt, and I just, at that point, I had the confidence to say, I know I can do this. I know I'm going to be successful. And I think that's a lot of work on limiting beliefs and mindset and other things,
Yeah,
but
yeah,
I've been able to get myself there. And I knew I was going to be successful. And we've had a great run in the first, gosh, I mean, we're almost 6 months here, not even.
Mhm.
And so I've been super happy with it, and now we're just continuing to grow.
Yeah. Oh, yeah. And it's, yeah. So this is often people are talking, they come from an environment where their life is very, very tough. And then, they make a decision and, they go somewhere. But there's something to be said about being in a comfort zone, leading a very comfortable life, and then deciding to leave that behind to start your own and then taking more risks. So so no
Yeah.
matter what, where you are today, if this is something that you want to do, I mean, you need to kind of like make that decision, make that jump. If this is, otherwise, you have only one life to live. So might as well live it on your own terms.
Yeah, I couldn't agree more. And I think that, it does take kind of a unique personality. I think I don't run into a lot of people that would do that. Most people tell me I'm crazy, but everybody thought every successful entrepreneur was crazy at the beginning of their career, right?
Yeah, yeah. So tell me about your kind of like your first deal. So you left Private Select, started Hudson Investing, and now so you're looking for a deal.
Mhm.
So tell us what kind of like you mentioned a little bit about your investment criteria, but kind of like how did you get started? How did you find your first deal, and how did you get into it?
Yeah. So, I did it. So we've done 3 deals since we got started really in June of
Mhm.
this year. And they were done a couple of different ways. So I'll mention a couple of different ways you can go about it. So one deal, I partnered with a friend of mine on, and he had a couple partners already. And so we kind of co-GP'd this deal. So there was 4 or so people. I wore a few different hats as far as some investor relations work, some underwriting work, really now some asset management work, because I own a property that's about 10 minutes from the one we bought. So they knew I knew the market well. Um, and so that's one way to go about it, right? Is to find others and partner and really do a kind of a co-GP type model.
Mhm. Yeah.
And then the 2 other deals that we did were actually with 2 different partners, but they were smaller deals. And so I decided that it would make sense and be beneficial to my investors to put them together into a portfolio. So we put a 29 unit and a 48 unit together into a portfolio so that we could have one bucket of equity. As the investors invest, they get one investment into 2 properties. Which helps them diversify, because one property is on the west side of Indianapolis, one's on the east side of Indianapolis, so totally different submarkets. And yeah, so that's how so on those, I'm the lead, really running the show, and so just different ways to get it done. But I think whether you're partnering or whether you find your own deals, and one of those deals was brought to me from from a person who is more novice, but was doing direct mailing, and got a seller on the hook, and brought it to me and said, "Hey, will you help me take this down?" I said, "Sure, it looks like a great deal. I'll help you get it over the finish line." And so that's a great way to partner, right? If you're getting
Mhm.
started, finding a deal like that and bringing it to someone who's more experienced is a great way to get started. And then the other deal was actually through a long time broker relationship. So I mean, broker relationships, you got to build those over the long term. But it was a situation where it was kind of a pocket listing. He was like, I'm going to show this to you and like 2 other people. And as soon as I saw it, I knew it was a great deal. So I said, I'll
Yeah.
take it. And so didn't let it get out to the broader market and go through a bidding war. And so it was like all of the deals were done in a little bit of a different way.
Mm-hmm. Yes, there's something that's interesting too about the sourcing. I mean, you mentioned this person that just like was doing direct mailing, found an opportunity and brought it to you.
Mhm.
And this is kind of like, I would say, wholesaling on steroids,
Yeah.
because now you're getting either you're putting that person as a co-GP
Hmm.
on your project, or you pay an assignment fee.
Yep.
But I know a lot of people, they don't have the money up front, right? So they especially don't have the money for a big project like a 40-unit apartment building. So this is a great way. So if you're listening and you know how to find these deals, sourcing these apartment buildings and stuff like that, then networking with investors like Kent, and and just contacting them
Yeah.
and say, hey, I have this deal in blah, blah, blah. Is this something that would interest you? And so, I mean, this is why we keep saying you don't always need money. Like if you find a deal, if you know how to find the deal and how to present the deal, the money is not the problem. The money,
Yeah, I mean,
you can find the money.
yeah, I would definitely argue right now in the market we're in, it's harder to find deals than it is to find money.
Yeah, that's right.
And so I think that's a great way to add value is to be out sourcing deals and putting that sweat equity in. And yeah, I made him a part of the GP. So he gets a GP interest, and it's mutually beneficial because, I live about an hour from the property. He lives about 10 minutes away. And so he's really leading asset management. And then I'm able to just kind of advise, but he's able to really go and execute.
Yeah, no, this is great. The other thing too that I like is that you kind of, I mean, and this is true of a lot of businesses, a lot of real estate projects that we do, is every deal is a little bit different. You kind of structure it a little bit differently because of, you have this other investors that you want to do a joint venture with or co-GP and stuff like that. Mm-hmm. So tell me about kind of like that flexibility, that the ability to kind of like structure the deal to the appropriate situation, I would say.
Yeah, I think in real estate, you just have to be creative, and you have to, it's kind of just an understanding that you can do whatever you want pretty much. You just have to have the attorneys that are knowledgeable enough to structure it in the right way and know that it's possible. Right. And so we've done deals a lot of different ways. Even within the properties that I was talking about, like that 48 unit. So an interesting story on that one is, the day that I handed the seller the contract, the PSA, was the day that Biden announced his new tax plan, and at that point, the capital gains could double, right? Yeah. And so the seller balked, and it was under LOI, but he didn't want to sign the contract because he was like, "I'm not sure I want to sell it if my capital gains are going to be double." He's like, "I might just hold on to it." Because I was willing to make this much profit, but not if I have to pay double the taxes. Mm. And so it took about a month of negotiating with him and coming back to the table 3 times and then away and back and away to structure a deal that worked for both sides. And we ended up, I had to take a little risk on that. A little more risk than I typically would have to get him to sign the contract. But I was fairly certain that nothing material was going to happen with capital gains before we got the thing closed. But I gave him a 30-day out. So during the due diligence period, either of us could walk away for the first 30 days. And that's not something, you would typically do, because typically the seller just wants to sell it and they're not gonna walk away. It's very non-standard, but it was a compromise that allowed me to ultimately get the deal done. And I had to take on a little more risk, but to me, it was worth it because I felt that the probability of that happening was pretty small. And over that month, I built a relationship with the seller and with his son. And, I had to take their word for it a little bit.
Yeah. I think people don't understand exactly how the system works too. I mean, the fact that the president, not just Biden, but any president says, "Oh, this is what I want to do. I want to cut the taxes or increase the taxes or whatever," it has to go through Congress. And by the time it gets through this, I mean, it's going to be completely different. Yeah. And so,
and that was a lot of that work in that month was education with the seller, of educating him and making sure that he was speaking with an accountant and an attorney, and that they were able to, like I was saying that, but that he heard it from other parties as well. Yeah, and I think ultimately that's what helped him get comfortable that, okay, like it's not just going to happen overnight. And,
exactly.
They're not going to come get you later and take half your money type thing. So that education, I think when you're working with like mom and pop, I think kind of has a bad connotation. I mean, it's not necessarily a negative thing. It's just that it was the only property he owned and he self-managed it. And he's just not really a real estate professional. Yeah. And, but when you're working with folks like that, you just have to do a little more hand-holding. Mm-hmm. And that was a big lesson learned for me on those deals, was you just have to be willing to do more, and maybe things that aren't necessarily like your job as the buyer, but it's just all about getting the deal done. It's like, do whatever you have to get the deal done.
Yeah, I think it comes to you kind of in terms of as the investor or the buyer to kind of like come with some credibility and then kind of like I would say like authenticity. So they say, you know, this is where I'm coming from, and you know, this is why I want to buy your property and all of that. And so I think it's kind of interesting. When we bought one of the apartment building that I bought in Memphis, I mean, we again owner operator. And now this guy's, we've bought a couple of buildings from him as well, other buildings. And then, so it was kind of interesting because he didn't see the value in his own apartment building. You know, he said, well, you can increase the rent by, you know, 50% easy on these things. And oh no, it's like this. Blah, blah. And, and that's why he was tired of it. He said, you can't raise the rent and stuff like that. And, you know, we raised the rent, you know, 50% or more on that building. But you cannot, you know that, and we share that with him. We think we can do this. And he kind of said, oh, no, there's no way you can do it. You shouldn't be spending money on renovating. So when we're going to change this, change that. And so,
but, I mean, you've got to have a vision for it, right?
Yeah, exactly.
You got to be able to see what the property can become, not just what it is right now. But like, I think another thing you said that is great is like you really have to have a passion for it. People talk to me all the time because they want to be syndicators, you know, and I tell them like, look, honestly, if you don't love it, like if you don't love doing the deals, you don't love the projects and love seeing the properties improved and come together, which I do, like the juice isn't worth the squeeze, because you could make a solid, you know, 15 to 20 to north of 20% return annually by just being a passive investor. You know, like, yes, you make more on, as running the deals, but like, if you don't love it, it's not worth it. Go do something you love and then make another 20% on the side, passively investing.
Yeah, exactly. Yeah. So speaking of which, I mean, why do you could do these deals probably on your own, you know, but you seem to be bringing some other people. You always build a team, and then you're doing these deals. So even all these deals, you're all doing syndication, even your first deal that you co-GP. So you had like syndication and stuff. Okay.
Yeah. So I've been a part of eight syndications.
Okay.
And of those 6 I've led and been the main sponsor. And you know, the reason I do it is because I got some good advice from a mentor, and it was like, okay, you know, so I was originally going to do like single families, and I have a small portfolio of like singles and doubles, but I was looking at it from a scale standpoint and saying, okay, you know, I want to be able to scale more quickly. And it's like, okay, well, I could go buy, you know, so I was turned on to multifamily. It's like, okay, I could go buy a 50 unit property or an 80 unit property. Right. And well, a mentor of mine said, okay, well, you got into this really to diversify. Right. But if you go buy, say, an 80 unit and you put all your money into that, well, you still have all your eggs in one basket. What do you do after that? Right. There's no growth beyond that. Yeah. So you're owning this building and running this building, but you're telling me you don't really want to be a landlord. And I'm like, yeah, you're right. And so that's where I really got introduced to syndication and the idea that you can, you know, you can pool your money together with other people and go buy something bigger and better than you can on yourself, and also diversify across a bunch of properties versus having, again, all your eggs in one basket. So I really liked that concept. Okay. And so that was why I really started syndicating. And then honestly, what I realized was the power of these type of investments and the returns that you can get. And I just feel like I've got a mission now to like tell as many people about this as possible, because a lot of people just don't know that you can invest in real estate in that way. And a lot of people are just stuck in their 401k doing the mutual fund thing and getting below average returns. And that's not a way to build wealth for retirement. And so that was why I started my podcast. All these things. I was like, man, I didn't know about this. And I thought I was a pretty savvy investor. I was a finance major in college with a concentration on investing and all this. Right. And And so I was like, man, more people need to know about this. And it's so cool now because I've been able to bring in so many of my friends and family into these deals. And it wasn't the first deal because everybody was like, yeah, we'll see how that one goes. And then, but it was like the third or fourth deal where like the people that knew me, my friends and family started to be like, hey, what are you doing? Yeah, let me get in on that. But now it's cool. Like when they get their distribution checks, they're all texting me like, hey, I just got my check. This is awesome. And I love that about it. I feel like I can change people's lives by giving them just a better financial position than they could ever have without it.
Yep. So what does your typical kind of a capital stack look like for these buildings?
Yeah. Typical capital stack would be 20 to 30% equity and 70 to 80% debt.
Okay.
So we're, and we're sourcing debt from either the agencies like Fannie Mae, Freddie Mac, or from local banks, community banks.
Oh yeah, wow. And then so for your equity, you have how many investors are you trying to get into these syndication?
It just depends on the size of the deal, right? It depends on how much equity is required, but the minimum investment is $50,000 for an individual, and from there, people invest up to 250, 300,000. It just, the average investment is about 65K because most people are in at 50. But then, I have a few people that put a couple 100,000 into every deal. Yeah. And so, I've got about 160 investors on my list, and so it just depends on, it's always a first come, first served basis. And it just depends on who's in it, kind of where they're at, how much liquidity they have, and if they're the first ones to the table.
Oh, that's good. So you must have a long list of kind of like investors that that you can tap into and tell them about there's a next project coming on and all that, right? Yeah,
it's about 160 people at the moment, and I've met those people in a lot of different ways. A lot of people find me through my podcast or through doing podcasts like this and reach out via my website, which is kentritter.com. And they fill out an investor application, and then they get screened by my team and they get on a call with me. And then after that, we're able to add them into the deal flow. Nice. And then depending on the type of deal we're doing, whether it needs to be friends and family and have a pre-existing relationship, or it's just open to accredited, kind of depends which lists we can open it up to.
Okay. So you're doing a 506 like B or?
So we've done B and C. So the B is the friends and family, right? We have to have a pre-existing relationship. And that's why I like to set up phone calls, like a series of calls. And we have a 30-day cooling off period to make sure that, we're not offering them investments too early. And so that's kind of, there's a list over here, and then there's the accredited folks, which, if we're doing a 506C, which we've been moving to more and more now as my investor base has grown, any accredited investor can access those. So it just depends on, we just make sure we're following the guidelines for the type of deal and the deal that makes sense. Sometimes on a smaller deal, I'll just do a 506B because I know I can bring in a small group of like friends and family, and that can be easier. And it's nice to give folks access to these type of deals.
Yeah, we deal a lot with like smaller investors as well. So, less than $100,000 investment in some of these like syndication, which are really like just more like joint ventures on these apartments. But so it's nice to keep in touch with them. They're much closer to their capital than some of the bigger investors and stuff like that. So that's kind of and I like yourself, I feel like we're really helping them, grow their equity, grow their investment so that they can go to the next level. So really like that.
Exactly right. Yeah. It's fun, it's cool. It's always just so cool when the distributions go out to get the messages and people are loving it. And so it adds an extra layer to the job. It's not just all about the finances.
Actually, so that we just sold one apartment building on last Friday. So now this week I'm gonna, just before Thanksgiving, I'm just gonna send them a wire for their principal and their profit. So they should be happy about that.
Yeah. Hey, that's a great Thanksgiving gift, right?
Yeah, exactly. Right. Just in time for the holidays. So tell me about your long-term strategies for these buildings. Do you have different exits for different building? You're always looking for projects that you're going to do value add and then exit in 3 to 5 years. What's the plan?
Yeah. So we're typically always looking for, I'd say we're always looking for value add. There's got to be an upside component to it. It's got to have a deficiency that we can solve, right? That's what we're looking for on the front end. And, we're typically holding them for 3 to 5 years. But the exit and time frame is property dependent, market dependent, depends on, but we always go into it thinking about what is the exit going to be? And I think that's critical. And I think you always want to have a couple of exit strategies. Exactly. So it's like, okay, we can, this one is in a market that is really up and coming. There's a ton of growth. So this is one that we're going to refinance, and maybe we're going to refinance this one 2 or 3 times, we'll give all the investors their money back. And just continue to let this thing run because it's got a lot of legs, right? But there could be another property where there's, we buy it at a great basis and we know it's really just a basis play, right? Where we can buy it below the market and we can add a ton of value, but it's not in an area where we maybe believe there's really long-term growth coming or substantial growth. And so that's one that we want to create the value and then sell it when the value's been created. And so, and that might be more of like a 2 or 3 year hold. And so it really just depends on the asset, kind of the vintage of the asset, the market, what's happening in the market. But right now, just generally, I mean, with the selling frenzy that is going on with all the capital out there looking for deals, I think the more quickly you can turn around your properties and get them back out on the market. I mean, you're just creating a ton of value for investors. Like we just sold a property in June that we held for 21 months. It was a 5-year hold is what we projected, but we could double the returns that we told the investors we'd get them in 5 years in 21 months. And so it was a no-brainer.
I know it's kind of, same for us too. Like, there's so much demand out there. It's kind of, I have people actually, we have 1 apartment building left right now. And the other 4 that we had, it was somebody out of the blue said, is this for sale? Is this for sale? I said, okay, well, the right price. Yeah, it's for sale. Yeah. And then, they hit the right price. So, okay, I guess we're selling. And it's a hot market from that perspective, even for that. So, and we had done the value add. So it was great for the investors. Investors are going to be very happy. And we held them money for like 2 years. So it was very good. Yeah.
Very good.
So what's the next step for you, Kent? So in terms of your business, in terms of your life?
Well, it's really all about growth right now. I mean, I feel like we've set a really solid foundation, right? With the 3 deals that we've done since beginning of June. And now it's really about growing. I've got a fairly large team. I've got about 7 contractors and VAs that work for me in different capacities, but we're bringing on our first full-time employee. We're going to bring on like a director level acquisitions position to just focus on sourcing, just sourcing properties and be able to do that full time, which will allow me to focus more on the thought leadership and the podcast and doing things like this and engaging with investors, which is what I love doing. And my goal next year is to acquire 1,000 units. My goal in 3 years is to have 5,000 units. And so pretty aggressive goals that I've set, but I think it's doable. I think if you have the right, like this is management consulting, right? You're putting the policies and procedures and the standard operating procedures in place, right? And then you just continue to execute on that. So for us, I think we have a process that works. I think we can always be better at sourcing properties and expanding our markets. And that's what we're really going to focus on building out the acquisition team around. And then after that, it's really, as we reach 1,000 units, it'll be building out the asset management team. So the execution team to focus on the properties that we own. And we're going to build out a couple of key teams and continue to grow.
Oh, sounds good. So Kent, we're about to wrap this up. Anything else you want to add? Where can people reach you? And you can mention your podcast as well, where they can subscribe.
Yeah. Thank you. So you can reach me at kentritter.com. That's my home base. And we've got videos and investor resources like FAQs, terminology. I've got a blog that I do pretty much weekly. You can also see my podcast and some other videos there. The podcast is called Ritter on Real Estate. You can also access that anywhere you listen to podcasts. And the podcast is really focused on helping passive investors make good investing decisions. So it's really understanding from the pros, what are they doing and why, so that we can replicate that. And yeah, from there, you can find me on social media. I mean, I'm LinkedIn, probably the most, just Kent Ritter, easy to find. You can DM me and be happy to talk.
Great. Well, Kent, thank you very much. It was a pleasure talking to you.
Yeah, thanks, Eric. Appreciate having me on.
All right, take care.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.